What if I told you that one morning in 1985, some of the most powerful men on earth woke up, straightened their suits, and stepped into a golden chandelier-lit ballroom in New York, where they calmly agreed to purposefully crash the US dollar? There were no conspiracies, no shadowy cults, and no underground bunkers, just finance ministers and central bankers speaking in quiet, steady voices while making a decision that would shake every major economy on the planet. One of them flipped through a stack of charts, his jaw tight, and whispered, "So, are we really doing this?" Across the table, an exhausted official, worn down by months of pressure, rubbed his eyes and muttered, "We don't have a choice. The dollar is tearing the system apart." It sounds like a movie script, but it happened. Most people have never heard the story. The Plaza Accord wasn't just an economic negotiation. It was when America, Japan, West Germany, France, and the United Kingdom joined forces and intentionally lowered the value of the world's strongest currency in a coordinated global effort. They did it to save the global economy. Although they succeeded, the consequences were far greater than expected, shaping world power for decades. To understand why they resorted to something so extreme, we must rewind to the early 1980s, a chaotic and tense period marked by inflation, recession, political turmoil, and intense global competition. Picture the United States in 1981, with inflation soaring, prices rising monthly, and people waiting in gas lines. Families were terrified that their savings were evaporating. Then came Paul Volcker, the imposing 6'7" Fed chair who smoked cigars. He didn't care how painful the remedy would be. "If we don't crush inflation now," he reportedly told Congress, "this country won't recover for a generation." And he meant it. Interest rates shot up to nearly 20%, businesses collapsed, mortgages became unaffordable, unemployment soared, but inflation finally broke. America took a breath. However, this victory unleashed an unexpected problem. As U.S. interest rates rose, global investors poured money into American markets for substantial returns. This influx of capital sent the dollar skyrocketing higher and higher month after month. "This chart can't be real," a Treasury analyst muttered in 1983 while staring at the nearly vertical line representing the dollar's rise. By 1985, the dollar had surged nearly 50% against the yen and the Deutsche Mark. It was no longer a strong currency. It was a wrecking ball. A dollar this strong made U.S. exports extremely expensive overseas. American factories couldn't compete. Car manufacturers, steel mills, and machinery plants shut their doors one by one. Entire towns in the Midwest collapsed. As a Ford executive famously said, "We can build the best cars in the world, but no one outside the U.S. can afford them anymore." Meanwhile, Japan and West Germany experienced the opposite problem. Their currencies were so weak that their exports were extremely cheap. Japan's trade surplus with the U.S. exploded. American politicians were furious. Congress began pushing for tariffs, sanctions, and economic retaliation. Japan panicked. Germany grew alarmed. France became frustrated. The UK became uneasy. Behind diplomatic smiles, there was fear. During an international summit, U.S. Treasury Secretary James Baker leaned close to the Japanese finance minister in a quiet side room and whispered words that would ultimately trigger the Plaza Accord. "Either we fix this together, or Congress will fix it alone. And trust me, they won't be gentle." That was the moment reality hit. Japan knew what American anger meant. Germany knew too. Thus began the secret negotiations, late-night calls, private meetings, and classified memos sliding across polished conference tables. Everyone agreed that the dollar had to fall, but no one wanted their own currency to rise. "Why should we take the hit?" one European official demanded. "Because the alternative," the American replied coldly, "is a global recession. Then everyone takes the hit." By September 1985, the pressure had become unbearable. The 5 most powerful economies scheduled a formal, decisive meeting. The location was the Plaza Hotel. It was one of the most luxurious buildings in New York, with gold ceilings, marble floors, velvet carpets, and chandeliers bigger than cars. Inside the ballroom, History was about to be rewritten. Picture the scene: briefcases clicking open, pages rustling, and charts spread across tables. An American economist pushed forward a graph showing collapsing U.S. factory output. If we wait another year, he warned, the manufacturing base will be gone. The Japanese minister frowned deeply. If the yen rises too quickly, he said, our economy will overheat. We lose control. The German representative exhaled slowly and added, we must act in coordination. One nation cannot do this alone. Hours passed. Numbers were debated. Risks were calculated. Consequences were imagined. Then finally agreement was reached, the Plaza Accord. It was a coordinated worldwide effort to weaken the US dollar by intervening directly in currency markets. Participants would publicly declare the dollar to be overvalued and instruct their central banks to sell billions of dollars in synchronized waves. When the document was signed, someone muttered, well, God help the markets tomorrow. They were absolutely right. The next morning, global markets erupted in confusion. Screens lit up as the dollar began to fall sharply. A Tokyo trader shouted, is this real? All of them? Are they all selling dollars? Billions moved within hours. Billions more moved within days. Over the next 2 years, the dollar fell 40% against the yen and 30% against the Deutsche Mark. American factories finally caught a break. Exports recovered. The Midwest began to breathe again. But in Japan, chaos was brewing. The yen's sudden rise threatened Japan's export-driven economy. In response, Japan's government slashed interest rates to stimulate domestic demand. Money became ridiculously cheap, too cheap. Loans flowed without restraint. Speculation exploded. Stocks soared. Real estate prices went crazy. Ordinary families bought multiple investment properties with borrowed money. Corporations borrowed endlessly to buy more land. Tokyo real estate prices reached absurd levels, prompting jokes like, the land under the Imperial Palace is worth more than the entire state of California. A Japanese banker later said, it felt like the country was floating on money. Everyone was rich, on paper, but bubbles always burst. When Japan's central bank finally raised rates to stop the madness, the entire system cracked. The stock market collapsed, real estate crashed, companies went bankrupt, banks were flooded with bad loans. Japan then fell into the lost decade, a period of such deep stagnation that some argue it never fully returned to its former power. Meanwhile, the Plaza Accord set off a chain reaction around the globe. Seeing the benefits of currency coordination, Europe pushed harder toward a unified currency, the future euro. China carefully studied Japan's mistakes and vowed never to let its currency rise too quickly. The world's central banks learned that coordinated interventions could reshape economies overnight. All of this because of one meeting in a golden ballroom in New York. Even today, economists ask, could there ever be another Plaza Accord? Could the US and China sit down together and deliberately rebalance the global financial system? Probably not. The world is too divided. China is too powerful to be pressured. Markets move at lightning speed. Still, even now, small coordinated interventions happen behind the scenes. There are quiet agreements, gentle nudges, subtle hints, and every time a currency moves in a way that seems a little too perfectly timed, someone inevitably asks, is this another Plaza moment? Ultimately, the Plaza Accord remains one of the most dramatic and consequential financial decisions ever made. It is a reminder that the global economy isn't shaped solely by markets, charts, or numbers. It is shaped by people, by politics, by whispered conversations in rooms the public never sees. It was the day the world chose to rewrite the rules of money. It was the day the dollar was pushed off its throne, not by accident or crisis, but by human hands. The world has never been the same since.